Welcome to Bloomberg Markets. I'm Sonal Basak. Let's get a check on these markets. Still lower on the day. We are off session lows. You are looking at the S&P 500 below 5,900, though. It is about 0.3% lower still as we hit midday. Nasdaq 100 more so, almost 0.4% lower. The 10-year, which has behaved like a haven bid this week in the middle of geopolitical conflict, that haven bid is now not quite there anymore. It is still below 440 on the 10-year, but we are roughly unchanged on the day. Bitcoin, though, is where you see a lot of excitement. It is up to more than $94,000 per Bitcoin. It is up another 2% today. Of course, investors looking to bank on options tied to Bitcoin ETFs, particularly IBIT. Now, outside of overall markets, investors are really focused on one name today, and that's Nvidia. Here's what to take away and what to expect from earnings that come after the bell.
The figures to look at tonight will be the margin levels and the market share levels, because $3.5 trillion of market cap and price earning ratio of Nvidia today can be justified only if they can keep their market share intact and also their margins intact.
Nvidia not the only mover today, down today. We are going to look at some other big movers on the equity side. Bring in Bloomberg's Abigail Doolittle.
Well, Nvidia really does actually have our eye, Sonali, because right now it is down on the day, although off of the lows, down about 0.75%. This is a two-day chart, so you can see today's volatility, and that's fitting to the options market on Nvidia. Options are pricing in an 8% move to the upside or downside. That could equate to $300 billion gain or loss for Nvidia. Now, what investors are looking for, in addition to what that guest was talking about in terms of margins, 74 cents in adjusted earnings on $33.3 billion in revenues, thereabouts. It's a little bit less than that. The big question is, can they put up another big beat and raise? The growth for both of those numbers impressive on a year-over-year basis, but it's decelerating in a big way. At some point, investors are going to care, given the fact that it's the top weighting to the S&P 500 and Nasdaq. All eyes on Nvidia. Now turning to some other midday movers, we have the shares of Alphabet down, although also off of the lows, down 1.5%. This, of course, on continued news around the possibility of a breakup of their company. In fact, we had a Bloomberg exclusive scoop today saying that Chrome, if it were to be broken off, could be worth up to $20 billion if a judge does order a sale. And then finally, Target. Lots of laggards that we're looking at in this midday movers, down 22.3%. That's the worst day since May of 2022. They missed adjusted earnings by 18%, sales by 2%. They had to cut the guide, the all-important holiday guide. It looks like Target does not have that Target feeling today or over the last several months. Let's see if they get it back.
Certainly a messy read on the consumer as we dive into earnings. Abigail Doolittle, we thank you so much for your time. We're going to turn now to the Treasury market that we've been talking about. There's an auction set for the top of the hour. Investors are still feeling out the Trump administration's budget plans. Earlier today, Julian Emanuel spoke about how politics plays a role with the yields.
The last week or two, the bond market has been a bit better behaved as we're trying to digest this all, and we've stalled out below 4.5 on the 10-year yield for now. We think if you start moving towards 4 3/4, and then, of course, the cycle high is at 5%, and that isn't our base case at this point, because, frankly, what we think when the Treasury Secretary is announced, whoever that person is, it will likely be a person who understands the dynamics of the bond market.
And for more on this, we are joined by Sonal Desai. She's CIO at Franklin Templeton Fixed Income, overseeing many types of fixed income, including global corporate credit and other securitized products. And every corner of the bond market has been certainly impacted by political outcomes. Sonal, when you think about what we know already, that might be a sure bet. What do you think is still not priced in with all the uncertainties that we have ahead?
I think, thanks, Sonali. I think the main thing which I would suggest has probably not been priced in because we can't price it in is what that fiscal deficit actually looks like. Even if we get a reasonable Treasury Secretary, I think we are likely to see some expansion of the fiscal deficit, and that is going to be the next leg in terms of bond yields. Not massive necessarily, but right now, I think the market is in a bit of a wait-and-see mode to see if everything that the incoming administration wished to do, it could do, it would be a massive fiscal blowout. We don't think that's actually likely to happen, but until we know, we can't really take a position on that.
When you think about the Treasury Secretary, what role do they play in the bond market? On one hand, you've seen that argument really come to the surface about the issuance that has happened at the short end of the curve. Would that change if you have a new Treasury Secretary? Doesn't the market ultimately determine what's possible?
I think so. I actually do tend to think so. Now, the Treasury's issuance is actually a technical issue almost. So I think it's less to do with the Treasury Secretary and more to do with the Treasury's plan on issuance. And I think that is a fairly technical part of the Treasury Department. The overall scale of the issuance, on the other hand, has a lot more to do with fiscal policy and where an incoming Treasury Secretary could guide the incoming administration in terms of what is possible and what is desirable in terms of fiscal policy.
I have a little bit of a not intuitive question here. I had an argument with a colleague earlier about this idea. Say Kevin Warsh, say he were to get the spot as Treasury Secretary. A lot of people in the market are saying, well, okay, Warsh was quite hawkish. But if you're in a different spot, this is not the Fed we're talking about, this is the Treasury, then can you be hawkish? Isn't your intent here to keep borrowing costs as low as possible?
I think your intent is to keep borrowing costs as low as possible, but you don't do this via the Fed. You keep borrowing costs low by running a more sensible fiscal policy. Now, he doesn't get to choose that fiscal policy, but he can guide it. I tend to think there is a limited amount the central bank can do, any central bank, the Fed in this instance, if the government is convinced that it needs to blow out fiscal. That is very much one of the determinants of what happens at the long end of the curve.
When we think about fiscal policy, maybe one productive way to think about it is through the range of outcomes. How far do you see the distributions here in the 10-year yield given one outcome or another?
So, look, I think my call for the 10-year yield was that we're moving to that 4.5–5% range before I knew the outcome of the election. Because I think something which people tend to forget is even under a Harris administration, there were plans to blow out conservatively. People were talking about a $3.5 trillion blowout in the deficit. Because those, and absent the counterpoint of what people have estimated as the Republican plans, $3.5 trillion is pretty darned large. So I'd say coming off several years of very large budget deficits, there doesn't really seem to be an outcome going forward where the deficits convincingly come down. And therefore, I think 4.5–5 is one side of it. And the other side, potentially, we could inch higher. The unknowns here are how GDP growth actually responds. If we do get growth positive fiscal policy, at least in the short term, that's likely to have a positive impact on growth.
You know, the deficit is one thing to think a lot about, but of course inflation is, and there's kind of two camps of thinking that tariffs could really start to set off inflation, really reignite a new wave even potentially. But then there's another form of thinking here, and I call back to a conversation I had with Citigroup CEO Jane Fraser. For example, this idea that productivity could fill a lot of that hole. What's the more likely outcome?
So, I think I wouldn't quite use the productivity issue here. And I'd actually go back to the first principles, which is tariffs themselves. The US is effectively a large closed economy in the sense that we're running close to 30 trillion in GDP. And tariffs, I think, are unlikely, they change relative prices. They're unlikely to have a massive inflationary consequence for the broad-based price level. Now, if we had the extreme version, 10 to 20% across the board, 60% on China, sure, we would get a one-time impact on the price level, and that could be as much as 0.5% to inflation. But to get an ongoing spurt of inflation, I think you need more than just tariffs. And therefore, I don't fully buy into some of the more deep fears on the ignition of broad-based inflationary pressures purely through tariffs, or a massive negative impact on growth, frankly, just coming from tariffs. I'm not saying they're a good thing. They're terrible. It's a bad policy. But I don't think it has the type of impact which has generally been feared. Separately, on the question of productivity, I think that's why the Fed's neutral rate is closer to 4, frankly. You've got 2.25% of inflation, and I think productivity is on track to be around 1.5, 1.75. And so it fills some of the space, for sure.
30 seconds here before I let you go. Is the Fed cutting in December?
I actually think I think the market's right. It's 50-50. I think it doesn't really matter. Ultimately, the Fed probably has in its gift no more than 3 more rate cuts. That's what I'd say.
Sonal, we thank you so much for your time today. That is Sonal Desai, CIO at Franklin Templeton Fixed Income. And coming up next, we're going to watch developments within the Trump's cabinet because a list of possible picks for Treasury Secretary is narrowing. There have been more meetings scheduled today with high-profile names like Apollo's Mark Rowan. We're going to give you details on what's happening under the hood next. This is Bloomberg. This is Bloomberg Markets. I'm Sonal Basak, and investors are keeping an eye on who could be the next Treasury Secretary. President-elect Donald Trump is scheduled to hold interviews today with former Federal Reserve Governor Kevin Warsh and Apollo's Mark Rowan. Everybody really waiting for the readout from those meetings. Bloomberg Deputy Congressional Editor Mike Dorning joins us now. And what do we know about the latest? It feels like over the last couple of days, there really has been a stunning amount of news coming out of this issue. I mean, realistically, this was something that much of the market expected days ago.
Yeah, and you can tell that it's kind of been moving around a bit. Howard Lutnick was one of the people who they thought might be in consideration. Now he's been taken out of consideration because he was named Commerce Secretary. And as you mentioned, they've kind of widened the lens of who they're looking at. Not just Apollo Management's Mark Rowan and the former Fed Governor Kevin Warsh, but Bill Hagerty, senator, spent a lot of time with Trump yesterday and is said to be someone who's being considered. And then Scott Bessent is still in the race.
I also want to talk about the process here because realistically, even though there's a wide slate for Treasury right now, you have a lot of, let's call it infighting over some of the other picks that the president-elect has made, but not just the picks, the way he plans to go about bringing those people into different offices. We have that he is poised to skip over FBI vetting. This is the president-elect poised to skip over the vetting of nominees. And that would break 60 years of precedent. Bring us under the surface of that decision and how that's going down with Republican lawmakers.
So this is something that even Republican senators are wary of. Traditionally, as you said, for the last 60 years, FBI has done background checks on senators on cabinet nominees before the senators consider whether to confirm them or not. Now, these FBI background checks aren't something you pass or fail. They're just an investigation, and they give an investigative file to the committee that looks at the nomination. The Trump people have said that there can be politically damaging information that comes up in those investigations, and so they're disinclined to have the FBI, looking and potentially finding politically damaging information. The flip side of that is the argument that investigating someone, vetting them, not only protects the Senate and lets them know about the person, but protects the president. He might find out something he didn't previously know about the nominee.
And it's interesting, according to our own reporting, that the Trump's transition team has not signed an agreement with the Justice Department and the FBI to allow the Bureau to vet these nominees. What about
Absolutely.
What about the Republican pushback? You had mentioned that there are certain senators who have already disagreed with this. And what does it say about the relationship that the president-elect will have with Congress on the get-go?
Yep. So this is going to be a point of friction, a point of tension between some more institutionalist senators and the Trump administration. People like Chuck Grassley, Lisa Murkowski, Susan Collins, maybe someone like Mitch McConnell, although he hasn't directly addressed it, someone like Bill Cassidy. These senators have said, hey, we want these checks. You should give us these checks. This will go faster if we get these checks. No one has drawn a line in the sand and said, there's no way I'm ever going to approve someone who doesn't have one of these checks. And likewise, Trump has not drawn a line in the sand and say, there's no way I will ever do these checks. But they're both signaling, Trump, we don't want to do them. A bunch of senators, hey, we want these, and things are going to go easy for you if you do these, easier for you. So this is a point of tension already, and this will continue to be a point of tension as the nomination confirmation process goes forward.
Mike Dorning of Bloomberg News, we thank you so very much for joining us here with the latest. And remember, tomorrow, Trump's former top economic advisor, Gary Cohn, joins Bloomberg Surveillance for an exclusive interview at 8 a.m. New York time. And elsewhere, we are anticipating possible breaking news today from the Manhattan District Federal Court, could come as early as today. Sentencing proceedings underway for Archego's capital management founder, Bill Hwang. Prosecutors had recommended 21 years in prison, but Hwang's lawyers have asked for no prison time, citing both his age and his health. In July, Hwang was found guilty of 11 charges, from fraud to market manipulation. As head of Archegos, he misled banks, inflating portfolio values to $36 billion before the bubble burst. For more on this, we are joined by Bloomberg's Sally Bakewell, who has covered the fall of Archegos. Your whole team has been all over this story from the inception. If we look at this moment now, what is the significance? Do we know much about whether he could get away with no jail time at all?
Right. So we were expecting sentencing today. He was indeed found guilty of fraud and market manipulation in July following the collapse of his $36 billion family office. And prosecutors want to see him face jail time of more than 2 decades, arguing that this massive fraud followed a pattern of law-breaking at his previous firm, Tiger Asia. But Hwang's lawyers argue he shouldn't face jail time, saying that the banks knew exactly what they were doing in trading with him. They're sophisticated firms. Now, we were expecting to hear sentencing today. But currently, Hwang is there. He went into court this morning with his wife and with his lawyer. He waved at his supporters in the courtroom, but we're yet to actually hear from him, and we did expect to. And currently, the court seems to be going through procedural matters. They're discussing the amount that should be awarded to victims. They're discussing, or Hwang's lawyers have objections to a pre-trial report. So it's looking slightly unlikely that we get the sentencing today, unless the judge really pushes things forward and we do get some sort of outcome.
Well, the sentencing hearing has been fascinating, and in fact, you can follow it at Bloomberg T Live on the Bloomberg terminal. In fact, you have actually a lot of disagreement still happening here. So how dramatic is today? As you mentioned, the sentencing was supposed to be concluded today, but might keep going.
It's been such a dramatic trial all throughout the summer. The courtroom was packed out, a lot of the time with Hwang's supporters, in fact. And now we're sort of at this unusual place where it seems like there's a lot of throat clearing in the courtroom, which may sort of indicate what Hwang's defense want to do after the sentencing in terms of appeal. They may be trying to create a lot of objection noise now so that they can refer to that in what they plan to do next.
You're right. You have the lawyers for Hwang even objecting to the calculation of a $10 billion loss to counterparties, saying that whatever the number is, they haven't shown that it was caused by any misrepresentation attributable to Mr. Hwang, but certainly we know, Sally, they lost that money. Anyway, Sally Bakewell from Bloomberg News, of course, leads our U.S. financial coverage here. And coming up, we're going to go to ETFs. Our weekly ETF report focuses on the big news from Nasdaq. We're going to go from mainstream finance to the world of crypto. It's the first options wagers on BlackRock's $44 billion Bitcoin ETFs. Those options will begin trading. This is Bloomberg.
It's an enormously larger amount of liquidity in the overall space, and that just raises the profile of the capital that can invest in the space. Options will help dampen volatility. And as volatility comes down, people can take larger position sizes, and you should see that it become more stable over time, and then people looking more towards fundamental use case than just as a sort of a venture-like equity risk bet.
That was Alex Thorne from Galaxy Digital speaking with me yesterday on the Bitcoin ETF options trading that has just begun. For more on this, we are joined by James Seyfarth with Bloomberg Intelligence. When I say just begun, we've had hours under our belt. This started a day ago. But, it's a new establishment. It's been an exciting establishment for the people who have not only been betting on Bitcoin, but Bitcoin ETFs and now options. How does this change the market, and what is the early intake as we know?
Yeah, I mean, this changes the market in the sense that it adds liquidity to the ETFs, like I just heard Alex Thorne saying on the crypto show yesterday. So yeah, it adds liquidity. It gives it more, these ETFs more of a Swiss Army knife-like appeal. There are some limitations. There's position limits of 25,000 contracts, which we can get into, that kind of limit how much that can be the case. And how has it been so far? Yesterday, IBIT had a full day of trading. They had about $1.9 billion worth of notional exposure to IBIT traded in these options on the first day of trading, which is basically shooting the lights out. That's extremely strong start to the day. And then today we had 5 other ETFs list options on their markets. And so far today, last I checked, we were about $940 million in notional exposure traded. We're not halfway through the day yet. So it looks like in aggregate with the 5 new ETFs that now have options, they're likely to pass or at least get somewhere close to the first day of trading, just shy of $2 billion in notional exposure.
But is this kind of one-way liquidity, James? I mean, at the end of the day, it lets you bet toward or against these ETFs, and the ETFs themselves had tremendous liquidity. You've seen a lot of means by inflows here. What does it mean to add options market wagering to them in terms of what it could mean for the price?
Well, theoretically, what it can do over the long term is allow people to get specific types of exposure. You can limit your upside by generating income by selling covered calls. You can limit your downside by buying puts, things like that. But what we've seen in the early action, specifically yesterday, and it's following through today, is most of the volume in these contracts, these option contracts, are call options, and they're out of the money call options way above the current price. So we're seeing that again today, even with the new ETF. So if you look at the put-call ratio, it's very tilted towards calls.
James, we got to leave it there, but thank you for joining us. We're looking forward to all your coverage on this. That is James Seyfarth of Bloomberg Intelligence. Stick with us for more markets. This is Bloomberg. Welcome to Bloomberg Markets. I'm Sonal Basak. Let's get a check on these markets because, as we've been saying, it is a down day, and it's a down day ahead of those Nvidia earnings that could be a blockbuster. But of course, expectations are very, very, very high. We have S&P 500 still below 5,900, and we have it down about 0.5% now. The Nasdaq 100 0.7% lower. Again, off of session lows for today, but close to them. The 2-year yield below 430. The 10-year yield at 438. Barely some movement there, but of course we have seen a haven bid earlier this week, now pretty much erased. We're going to also look at some midday movers on the equity side. We're going to bring in Bloomberg's Abigail Doolittle for that.
One of the big percentage movers to the downside for that S&P 500, Sonali, is clearly Target, down 22%, its worst day since 2022. They put up a massive miss for their third quarter, essentially missing earnings by 18%, sales by 2%, not able to lure customers to buy more with price cuts. There were inventory problems. So there continues to be this bifurcation amid the consumer, mixed signals about some stores doing well. Walmart put up a good quarter as the higher income shoppers going there, but clearly not to Target, and under pressure as well. These companies report in 2 to 3 weeks. Dollar General and Dollar Tree both down down more than 4%. They've been in a world of pain this year, too. So this is the negative side of the consumer story today. But take a look at Williams-Sonoma, this high-end kitchen store, up 30%, the best day since 2008. Investors want in on this. They beat estimates and by 11% on the bottom line and for a 1% revenue beat. The outlook looks good. There's also a short squeeze here, so that could be a piece of this gain. But again, it's really interesting to see Target down 22%, Williams-Sonoma up 30%. And then finally, the reason from a point standpoint that we have the S&P 500 and the Nasdaq 100 down so much. Take a look at big tech. Now, this has to do with Nvidia. Nvidia down on the day ahead of that report, options saying an 8% move up or down. If it were to be the downside, investors getting a little bit nervous here, a little bit cautious that that could roll into the big tech sentiment. So these are the big point drags on the day, Sonali.
Abby, thank you so very much for keeping an eye on it. Of course, still in the middle of earnings season, but there's a lot of other corporate news out there, too. Ford shares are falling after it revealed plans to cut around 4,000 jobs in Europe, primarily in Germany and in the UK, and it's by the end of 2027. For more on this, we're joined by Bloomberg's Keith Naughton, who has been covering this story, and Ford has seen a lot of change this year alone. How does this most recent establishment fall into the big picture?
Yeah, this is part of Ford's overall cost struggles. They say they have a $7 billion disadvantage to competitors on their costs. So they're looking for any way possible to cut costs. They've been cutting costs in their EV operations, which are struggling, and now they're cutting these 4,000 jobs in Europe to attempt to become more competitive. Europe faces some of the same issues we have here in the United States, which is EVs are not selling as expected, so they've had to slow production of their electric vehicles in Europe. And one factor in Europe that doesn't exist here is the Chinese competitors have come in there and are gaining share, and that's a new competitive threat that Ford is trying to work against.
You know, if Matt Miller were sitting here instead of me, you know, he would ask you about the European market and why it's such a bear. I mean, what is going on in Europe and some of the problems that we're seeing there for Ford, can we see it spill over to the United States?
Yeah, I mean, there are some similarities, but Europe was ahead of the United States in the electric vehicle uptake. But suddenly, you know, as with the U.S., things are slowing. Governments are pulling back on some of the consumer incentives that they had offered people there. So Ford just launched 2 new electric vehicles in Europe, an electric Explorer and an electric Capri, and those 2 models are not selling well. So at the factory in Germany that makes them, they're going on a week, off a week. They're going to reduce production in the beginning of next year as well. So it's not turning out to be the market that Europe had previously or is expecting, or that the regulations are set up for, because there are these very stringent regulations coming on in Europe, and the automakers like Ford are saying, we can't meet them if consumers don't want to buy these cars.
It's interesting because since mid-July, we've seen a significant sell-off in the stock. What do they really need to do at this juncture to turn this story around? Because even today, you're seeing the shares down 3.4% on the back of this. They're telling investors that the reason they're doing this is to improve those margins relative to their rivals. But even this, investors are not biting on, probably with the potential that this gets more expensive before things get to become a clearer story.
Absolutely. Normally, when there's a big job cut like this, you see shares go up. That's not happening here. You know, the big thing that set this off was in July, they revealed that their warranty costs were much higher. They are the most recalled automaker in America, and they have some quality issues. And those things take a long time to fix and an even longer time to show up in the earnings. So I think investors are taking a very skeptical view of Ford right now because they have a lot of work ahead of them.
Keith, we have to leave it there. We thank you so very much for your reporting, not just today, but every day. Of course, this has been a very large story. The auto industry at large trying to weed through some troubles and this transition with electric vehicles. But coming up next, we're going to talk about the really big story of today, because all of Wall Street is watching for Nvidia earnings due after the bell today. And we are so close. We are just off those record highs for the stock, down today, but big expectations for later. Stick with us. This is Bloomberg. This is Bloomberg Markets, and I'm Sonal Basak. It's time now for the stock of the hour. There is no bigger stock today than Nvidia. It's set to report quarterly results after the bell today, and it has been a massive contributor to S&P 500 gains this year. So everyone is watching these numbers closely. That includes our own Bloomberg technology co-anchor, Caroline Hyde, who joins us now. And I know you have all the numbers at play here on what a big move this could mean. $300 billion either way, bigger than most companies.
Yeah, more than I think there's only 25 members of the S&P 500 that an 8% move by Nvidia would actually eclipse in terms of market capitalization. So no wonder both Bank of America, both Barclays are saying this is a macro event. I mean, it's funny, isn't it? There's a whole note out there that says crypto is macro now. Crypto is 3 times less the size of a market capitalization than Nvidia. Nvidia is more than $3.6 trillion now. And if you go into what we're looking to, look, the minutiae are going to be about not just what the third quarter looks like. Have they managed to drive up revenue once again to the tune of about 80% increase year on year, about 10% quarter on quarter? But what about the fourth quarter? And what about supply side issues that we keep on hearing are being the issue for Blackwell? Are we able to see from Jensen Hwang putting to bed of any of those anxieties, whether it's about overheating or whether it's about design side too?
Design side and supply side and overheating all feel like fairly large issues.
Yes.
However, a lot of that was telegraphed to some degree as well. He's been so good at brushing off the concerns, but with these concerns in particular, you think he's going to be able to do it this time?
The bar keeps getting higher and higher because ultimately they meet, they beat, and then everyone anticipates that he's going to live up to the whisper numbers, as they're called, once again. They do need to keep forecasting that ultimately the demand for compute power remains no matter what. We identified from the latest numbers from their customers, the Microsofts, the Metas, the Amazons, that they are still committed to buying and spending when it comes to AI accelerators. But what then of the fourth quarter? What then of 2025, 2026? How much are we going to see compute power still mean scaling laws are intact? Are we going to have ever more powerful large language models because you just throw data at these ever more powerful chips, or does something have to nuance here? But I think most people do feel that the scaling laws apply, that the scaling laws therefore apply to Nvidia, and that there is no other game in town yet. Yes, AMD's been chipping away, but Gaudi, no demand there from Intel. It really is an Nvidia game to lose here.
Caroline, please stick with us. We are now going to also bring in Northern Data Group COO Rosanne Kincaid-Smith. Her company is Europe's largest Gen AI cloud platform, and it partners with companies like Nvidia, it partners with Nvidia. And very curious to hear about how you are looking at numbers, because you're investing in your own platform alongside theirs in so many ways.
Hi, Sonali, and thank you very much for having me again. And thanks for the great summary of what Northern Data does. I mean, as Europe's largest provider of cloud services, we actually do rely very much on Nvidia, and we've got a great relationship with them. But I think businesses like ours and Nvidia's are absolute testament to the significance of AI and the runway that it has to go. So we're seeing exponential demands, and that is definitely a driver in our business as well as in Nvidia's.
Let's just dig into a little bit around your business model more broadly, Rosanne, and it's great to be able to take part in this conversation, so thanks to Sonali for it. We've spoken before on the tech show as well. And
yes,
look, ultimately, we're all trying to understand what wild demand ends up being in the longer term. The issue for Nvidia is actually whether they can meet demand with supply. How much have you found the infrastructure issues, the offering of cloud is actually what holds you back rather than the demand side here?
So I think what we're actually trying to get to here is the commentary around Blackwell delays. And I think NVIDIA actually responded to that quite well. And engineering is, particularly with transformational technology like this, an iterative process. And I think it's to be expected. But as an elite partner of NVIDIA, we work very closely with them to ensure our own deployments run smoothly. And so when we see that demand, we recognize that actually we've successfully deployed over 20,000 NVIDIA GPUs across our tech estate. And we look forward to partnering with NVIDIA on the GB200 technology. And those will be the prime solutions for our customers going forward.
When you think about customers moving forward, how do you see that customer base expanding? Because you look at the big tech companies out there, you looked at how investors reacted to their CapEx spend. But at what point does the market start to evolve beyond the companies that are currently relying on companies like Nvidia and yours today?
I think you'd be surprised just how evolved that market is. So I think we are often lost in the context of some of the broader hyperscalers and applications like ChatGPT. But we are seeing global demand for our cloud platform based in Europe. And that customer base is well beyond model making. There are small to medium corporates who are training their own LLMs. And there's also that emerging market of inferencing that is ultimately going to drive an entirely different revenue stream and different customer base.
You've talked often about your own leadership position and ultimately what drives it. You've talked about how generative AI, of course, is the driver here. But what I'm interested in is why the infrastructure that's currently being built, why the innovation behind a Blackwell system, for example, is so darn hard. And in many ways, we've been reporting, you said, Jensen Huang's dealt with some of the controversies well, but there is this issue of cooling. And when you have such massive data centers with such powerful compute, it's going to get incredibly hot. You're doing a lot of liquid-cooled infrastructure. How hard is that?
It's pretty technical, but what I would say is I think the focus is certainly on Nvidia, and rightly so, because the expectations are high. But I've actually just been in Barcelona at the HP Discover event, and I can say that there is an enormous amount of innovation happening behind the scenes and with Nvidia's partners in the OEM space, with HP, with the Cray devices, with even companies like Gigabyte, who are providing solutions to tackle all of that very, very hot infrastructure. But let's not also forget that we've also got things like that we employ at Northern Data on circularity. So while things are hot, and that's true, and there are technical difficulties with liquid cooling, there are also other use cases for all of that heat. And we can actually reuse that and find creative and innovative ways to repurpose.
Rosanne, we have to leave it there, but wish we could go on even longer. Certainly the story of the day, perhaps the story of the year in a lot of ways. Rosanne Kincaid-Smith, COO of Northern Data Group. We thank you so much. And of course, our own Caroline Hyde. Looking forward to that coverage of these results. Now, coming up, our Money Undercover segment. We're going to be speaking with Avi Kalichstein of Hunter Point Capital, one of the newer fast-growing companies in town. That's up next. This is Bloomberg. This is Bloomberg Markets, and I'm Sonal Basak, and it's time now for Bloomberg Money Undercover, our weekly segment where we cover the unique challenges and opportunities facing alternative investments. And for that, we're going to turn it over to Bloomberg Surveillance co-anchor Lisa Abramowitz.
Thank you so much, Sonali. You know, we've been talking a lot about how animal spirits and public markets have been turbocharged over the past 2 weeks. And really the question that a lot of people have been asking is that going to be the truth in private investing? Joining us today to talk about that is Avi Kalichstein, who formed Hunter Point Capital with Bennett Goodman of GSO fame back in 2020, a very quickly growing company. Avi, I'd love your take, first of all, just on what the strategy is of a company that isn't just directly investing in the actual companies and traditional investments.
Absolutely. For context, Hunter Point Capital is a GP solutions firm. And that means we make permanent minority investments in the equity of alternative investment managers around the world. That could be private equity firms, private credit firms, real estate, or infrastructure businesses. And we've recently also started a business that makes shorter-term financings for those same set of companies. So we have about 600 GP relationships around the world and about 2,800 LP relationships around the world. So that gives us a really interesting perch from which to look at the private markets.
Avi, before we get into just the actual lay of the land, I am curious how this is different from providing leverage or providing some sort of credit line to companies that are, say, invest in a lot of private equity companies that they haven't been able to spit out or sell or have merged, and so they need to have capital to meet redemptions and make other investments.
Absolutely. So our core GP stake strategy is really a growth equity business. We're looking for the next generation of leading alternative investment managers in the world. Firms like L. Catterton or Collar Capital or Pretium, where we've made investments to help them grow their businesses. And then we bring strategic capabilities to help them achieve their goals a little bit faster. So it's quite different from a business that's about underlying portfolio companies operating businesses. These are all financial institutions and specifically asset management businesses.
Avi, it's not like things have been exactly slow, but certainly in certain sectors, there's been this hope over the past couple of weeks that there's going to be some sort of growth injection into certainly U.S. markets, and you've seen that in public markets. Have you seen a similar type of follow through in private debt, in private equity even, among some of your partners?
Well, let's remember that private markets just move much more slowly than public markets do. So it's one of the beauties of the public markets. They can react immediately. The private markets are a little bit more delayed. So I think the big question on everyone's mind is the sort of suspense thriller that we're in. Are we going to continue the decline in interest rates that we've seen that has precipitated some more M&A activity and a bit of a thawing in the private equity markets? Or are we going to face a new round of inflationary pressures that could thwart that return to normalcy in the interest rate environment? And so that feels like everyone's waiting to see what direction that's going to head.
It's a fascinating question at a time where, in some ways, over the past couple of years, private debt has kind of taken the lead in terms of attracting capital and certainly being an asset class in favor du jour, while private equity has had a harder time simply because of some of the mergers and acquisitions that have been stymied and IPOs that haven't necessarily come to the fore. Do you think that that could potentially switch back, where private equity gets a little bit more attractive even than private debt, if there is, say, stable interest rates and mergers and acquisitions are more amenable?
Well, I don't think it's one or the other. There's certainly a lot of momentum behind private credit, and I think you'll see that continue. And that's partly because interest rates are higher, and so for floating rate products, investors are seeing the opportunity to get almost as much return as they could on their equity products, so they may as well get the protection that credit offers. But I do think we've started to see a thaw in the private equity business. I think you've seen a thaw in the fundraising for it. I think you've seen the rise of tools like continuation vehicles and NAV loans that are permitting a little bit more liquidity to come back into that market.
Do you get the sense, Avi, that for a number of years, some of the private investment structures have really benefited from the regulations of larger banks because there are certain businesses just that haven't been as profitable for the biggest banks to do, that if there is deregulation, that could potentially make it less advantageous for some of these asset classes? Do you have an area that you're kind of, I don't know, thinking might become less appealing, or do you think that there are still opportunities across the board?
I think there are broad-based opportunities. Something fascinating that we've seen is as that regulation and capital constraints pushed the banks out of the private credit markets, that gave rise to the alternative credit managers. But interestingly, recently, we've seen some of those same banks partner up with the alternative credit managers to kind of get back into that market a little bit, even though they can't do it directly with their regulations and their capital requirements. So I think there's a partnership model that can continue to evolve, even if regulations ease some.
So going forward, what are you watching for? What's your sort of big question for the upcoming year that will inform how you decide to allocate at a time that you just closed, I believe, a $3.3 billion fund, and you've been rapidly growing? What's your kind of vision for the year ahead? Well,
we have to remember that our strategy in stakes is a very, very long-term one. And so we can't be making decisions based on either short-term changes in policy or short-term changes in rate, because we're investing for multiple decades. That said, I'll use Pretium as a great example. Pretium is the country's largest, or the US's largest owner of single-family rentals, and among other things. And they also have a residential credit business. We see tremendous growth in that business as the housing shortage continues to make it difficult for for regular way homeowners to, or families to own homes. So we see a kind of secular demand for that kind of product that has nothing to do with interest rates.
Avi Kalichstein of Hunter Point Capital, thank you so much for being with us. We take a look at the structure of investing in alternative asset managers. From New York, this is Bloomberg.